So I am Francine McKenna, and I am sponsoring this series here at the Pen and Pencil Club. So this is our second official so far. Thank you so much for coming. And today I have Brady Dale from Axios, who's written this fabulous book about the FTX failure, but particularly about Sam Bankman-Fried. Tell me again the official title.
SBF, how the FTX bankruptcy unwound crypto's very bad good guy.
Very bad good guy. So there's a lot here about the psychological and the altruistic or non-altruistic aspect of Sam Bankman-Fried, whatever you've heard. We have the good fortune of partnering with Head House Books over from Second Avenue or 2nd Street? I'm from Chicago, what do I know?
2nd Street.
2nd Street. And so if you need a book, if you want to pick up a book, Brady will sign them. We'll have some signed ones that'll go back to the store. So if you don't want to do it tonight, you can order them online, or you can go visit the store. Go visit the store. It's a nice, very nice store. So what we're going to do is Brady's going to talk a little bit about the SBF mystique, who is SBF, and then I have some questions, and then we're going to leave the last 15, 20 minutes or whatever for your questions, but we'll be here for as long as you want. So we'll go from now till about 8:30 or so on that program. So again, thanks for coming. Brady, tell us about SBF.
Sure.
And about writing the book, a little bit about writing the book.
Sure. Well, hey, everybody. Thanks for coming out. Great to see everyone here. I want to say it's great to be at the Pen and Pencil. I lived in Philadelphia from, I think it was 2005 to 2013, but I wasn't a journalist then. I was kind of on, I guess we call it the editorial board of this blog that was once kind of important here called Young Philly Politics. It was like pretty hot during Mayor Nutter's election. It was like influential then, back when blogs still kind of mattered. But I was here many times for various reasons. Mostly, I confess, I lied after other bars had closed to get in the door and said I was a writer and came in here late at night. But then eventually I came to some other events that happened here. So the Pen and Pencil is a place I've been to for a long time. I'm finally here legitimately. That's exciting. The book is about the crypto crisis that hit, that sort of culminated in November 2022. But it's really about Sam and Sam Bankman-Fried, the founder of FTX's history within crypto. There's if you want to find out about Sam's childhood or the stories his mother told him at bed at night, there's none of that in here. But from the moment he arrives in crypto in 2017 to when FTX blew up, I cover as much as I could uncover of his life story. And so what happens, with Sam, just with a quick overview of who Sam is and kind of what that story was. He was apparently a fairly gifted trader at Jane Street Capital, which is a fancy trading firm in New York City, doing pretty well at that. But he had bought into this idea of effective altruism, which was this notion that you should do as much good with your life as you possibly can. And for most people, that meant make as much money as you can and give it away. That's the altruism. But what a lot of people don't understand about effective altruism is there is that effective piece. And so what the effective piece meant is the way you gave the money away should be done sort of as studiously and as informed by data as possible. And this all very much appealed to Sam. And so he tells this story that he went on this sort of vision quest to decide what he should do. Maybe I'll be a journalist, maybe I'll go into politics, maybe I'll go work for an EA nonprofit, maybe I'll start a business. I actually don't really, some of the sources I talked to, I don't really think that that's actually true. I think that was a story in his mind, but I think he quit Jane Street and in almost zero time realized there is a rare opportunity to make piles of money trading crypto, and that's what I'm going to do. And so he starts Alameda Research in 2017. And this is interesting for me because that is when I went full-time as a crypto reporter too. I was working at the New York Observer from 2015 to 2017, did a little writing about cryptocurrency, got noticed by this big site called CoinDesk, which was pretty small then and had just gotten enough money to hire up some more their editor, Pete Rizzo, was looking for more crypto reporters. He had very particular opinions about the people who he would hire. He wouldn't hire anyone who hadn't written about crypto before because I'd done some. He gave me a shot, brought me in. So I started it at CoinDesk in October of 2017, a few months after Sam had started Alameda Research, but I had already been kind of writing about ICOs at that time. And so Sam, no one knows exactly where his giant pile of money came from. He says he got he got some money in. He says he made most of his money on the arbitrage between the price of Bitcoin between Japan and the US. A lot of people say he really did it off of the price of Bitcoin between Korea and the US, whatever. Did a bunch of that kind of trading. And then when those arbitrages dried up, he started finding lots and lots of other ones. And so he did that for a while. And what was interesting is like none of us really knew about him. Like, Alameda Research wasn't something that crypto journalists talked about from 2017 to 2020. Then he starts FTX a little while after that, a year or so later. We all kind of noticed it. I remember there was a period in like 2018, 2019 when somebody at CoinDesk sort of sent a note FTX to me, and I saw that they had something on their site called the Shitcoin Index. Like you could basically bet on a bunch of like crappy cryptocurrencies, and you could you could trade with them or you could trade against them. And I was just like, well, that's pretty funny. I should write about that. But I never got around to it, and I didn't know who Sam was. I didn't find out who Sam was until 2020 when this thing called DeFi Summer happened. And DeFi Summer was this time when these decentralized finance, these open finance projects were finally starting to really click with the public. And a part of the reason why they were clicking is because they all needed people to entrust them with a bunch of money to use them. And they only worked well if there was a decent amount of money thrown in. And so the way they would convince people to throw money in is they would create a thing called a governance token. And they would say, look, if you throw money in us, if you use us in some way, you provide us with liquidity, it will be safe for various assurances, and that was true at different levels and less true at other levels for different projects, but they had promises of safety, and then we'll just give you this governance token on top. And I remember when this was started with this project called Comp, I was sort of like, I don't know, that seems weird, doesn't seem like that big of a deal, but whatever. And then once it kicked off, like it really exploded, and the market got super excited, and they were just piling money into this project Compound, and people are hoovering up these governance tokens, and so everyone started copying them. And Sam and Alameda Research go out and start dumping their giant war chest into all these projects to get as much of those governance tokens as they could, and to do exactly the opposite of what people hoped they would do. People hoped the governance tokens would convince people to stick around, hold the tokens, be committed to the project. What Sam was like, oh no, that's a sucker's bet. I'm gonna throw a giant pile of money in, earn the lion's share of the governance tokens, and just sell them immediately. And so Sam describes that as a rare opportunity to like make vastly more money than anyone had ever seen before. And they saw it first and were getting giant piles of money out of it. And so then Sam kind of appears on the public scene because that's the first time he really needs to interact with people in public. And that's sort of when I find him in 2020. And from 2020 to 2022, he's just this boy genius who doesn't seem like he can do anything wrong. And he's very open to talking with journalists. I talked to him a bunch of times. We texted all the time. I talked to him on the phone several times. We had long conversations. He seemed like this really smart, really eloquent, really thoughtful person who, clearly he was a capitalist. He was trying to make as much money as he possibly could. But it seemed like he was trying to do things the right way and was taking this very long-term vision. I completely bought that. Like, I'm very clear about that in the book. I was totally bought into the Sam story. I thought he was not an idiot. I thought he wasn't a crook. I thought he was not only trying to play by the rules, but trying to get rules for the whole industry. I believed all that. I mean, I also suspected that he probably was trying to get rules because he wanted rules that would work well for him and his company, but that's what everybody does, And so, but then in November of 2022, things blew up, and that's a day that as a journalist, I'm not going to forget. Like it was an unusual day, and then I'd gone into the Axios offices. I don't, we're all work from home these days, but I don't remember why, but I went in that day. It was election day in the United States, and so I go in there thinking, I was like, well, we'll finish up our newsletter for today. We do a daily newsletter, Axios Crypto. Finish up what we got for our newsletter. Then I guess I'll just see how Sam's bets in the elections worked out. I don't know. I guess that's what I'll do today. And I'll write something about that for tomorrow. And then news broke from the block that withdrawals from FTX didn't seem to be going through, and you could see it on the Ethereum blockchain. This is one of the things that's cool about crypto, right? Is that an exchange is a black box, but they've got these public addresses, right? And if those public addresses aren't moving money, something's wrong, and the public addresses weren't moving money. And I remember the guy who was here last time, Felix Salmon, was the prior person here, was just like, how is this not disastrous? And I was just like, well, I don't know, Felix, like, you know, he's a little more crypto negative than I am. I was like, it could be, there's a lot of reasons it could happen, you know, there's a lot of stuff going on, I don't know, whatever. But no, it turned out that the whole world was blowing up. Like, that's what was happening. It took me I remember one thing I said, and I think I say this in the book, is I was like, this will probably be our topic for the newsletter tomorrow, I guess. And then Felix in Slack was like, this is your topic today. And I was like, okay, cool. And so we just threw out everything we'd already written, completely tore it up, wrote a new newsletter really fast. And yeah, FTX was exploding, and it just sort of was this endless dumpster fire that dumped more things out for the next 6 weeks. And, you know, along the way, there was an editor at Wiley who was like, you know, we should do a book on this, and we should do it really fast. We should beat Michael Lewis to press. That was the idea. And so he started looking around for someone who's willing to do it, and to do it at crazy speed. And I had already kind of been thinking about a Sam-related book already, and I'd done some work on it. And he heard me on this podcast called The Tech Meme Ride Home. I made a little joke that they reread on the air about how the FTX explosion worked. He thought it was kind of funny. And so he was like, would you want to write a book? I said, sure. And 6 weeks after that, it was done. So that brings us to today. Yeah.
6 weeks.
Yeah, 6 weeks. Yeah.
Did you sleep?
I did. Yeah. I did.
I will testify it's a very readable book because it was written, I think, quickly. I think based on a lot of your existing reporting,
Mm-hmm.
but clearly you did additional interviews. You did a lot more, you know, deep diving. But it's a very readable, fast-paced, well-organized book. So
Thanks.
I could see the journalist in there
Mm-hmm.
kind of thinking through, how am I going to structure all this material, and
Mm-hmm.
how am I gonna get it done, but not knowing that you did it because it was a 6-week thing.
Yeah.
So let's back up a little bit.
Wait, on that, I just want to say,
Sure.
on the 6 week thing, there was times when I was doing it when it was like very fun for me, and I was like, I don't know if I still think this is true, but I was like, this is how people should always write books. This is the correct way. Like, people way over obsessed, just like bang it out, like just get the information into your head. And the nice thing for me was I already knew most of the story, like because I was a beat reporter in this area, so it wasn't. Most of the events, I knew what had happened, and so that helped. I didn't have to do a bunch of like raw research. I couldn't write a book in 6 weeks on like, I don't know, the Ukrainian-Russian war. Like, I could not do that. But there was this idea I had while I was in it. I was just like, this is very good, and I think this is the right way. Like, just do it in frenetic speed. I don't know if that's still right, but I very much believed it at the time.
So that sort of leads really well into my first question, because I've watched this phenomenon with journalists writing books, in particular when something big happens,
Mm-hmm.
like the financial crisis or Enron, or all those different points in time where there's something really big that happens, and journalists are on it, and they've been reporting on it, and you look around and you say, who's going to come out with the books? Who's going to grab, the opportunity to write the books about it? And I have like kind of mixed feelings about the fast book versus the slow book.
Mm-hmm.
The book that's ripped from the headlines, it's 80% reporting, versus the one that is something completely new.
Yeah.
And so the question is you kind of drew the line on, this book, December 2022.
Yeah.
Okay, so you were done with reporting, you had a draft, you had to deliver something.
Yeah.
I don't know if you had an opportunity to make any significant changes or updates after that, like before the book actually was published. But the idea is, tell me, you like the fast production process because that worked well for you, but tell me about sort of the advantages and disadvantages, because a lot has happened with FTX and Sam Bankman-Fried. We know a lot more than you did in December.
Right.
So what's the advantages and disadvantages of like hot off the presses right when a scandal blows? I mean, I'm thinking of like the Theranos book, John Kiriru. I was at Market Watch at that time, and I remember him writing, all the stories, and then he was going to write the book. And I remember he actually was ready to have the book published, and they had not even been had the complaint from the SEC yet,
Mm-hmm.
let alone the Department of Justice, the criminal stuff.
Right.
Like he was going to come out with his book based on all of his reporting,
Right.
without even like that there had been any kind of enforcement actions against
Right.
those folks. And then he found out about the SEC thing, and they delayed the publication 2 weeks.
Mm-hmm.
And then he had to like follow up on all the prosecution stuff. So you were in sort of the same boat, although you got all the charges. So you got,
Right.
before December we had all the charges. So tell me what kind of the pros and cons are of doing it fast, getting it out there, versus waiting until you actually know what the end of the story is.
Yeah, no, it's complicated. Well, I mean, I think, some of the most popular books that people are buying, especially in nonfiction, are about things that happened 100 years ago. So,
Like for example?
well, like, that, like The Devil in the White City, that guy was,
Oh.
like he does all his books, like,
I'm thinking of like Andrew Sorkin's book from the financial crisis, which was really, really early
Mhm.
out there.
Yeah, Too Big to Fail.
Too Big to Fail.
Yeah.
Really early.
Yeah. No, it's a mixed bag. I mean, there's this like super philosophical thing I say at the very, very beginning of the book, like this super sort of heady thing. There was a level on which I was kind of disappointed that the charges came out before the end of the year. I was sort of hoping it would take longer, because I don't know if this makes for a good book, but I liked the idea of like, one of the things that I've found as a journalist is like, something happens, right? Like something blows up, a bunch of money disappears, some scandal breaks, and you think it just seems like, oh, the explanation is obviously whatever, based on the situation, like it's obviously this or that. And then a thing that often happens is as you find out more, you start to see that differently, but you also you kind of can't even really comprehend or even remember the way that you saw it when there was less information out there. And to me, this is such a big story, like not just Sam, but this moment in this thing that I think will be important for a long time, cryptocurrency, that I sort of wanted to preserve just that feeling of like how we understood the FTX blow up before any real official accounting of it had come out. Then we got a little bit of an official accounting. I mean, we don't have a trial yet, so we don't really know. But like the SEC charges come out, the CFTC filing comes out, and the Justice Department really didn't say anything, but especially in December. But they sort of nailed some things down somewhat more, and it was just like, well, you sort of lost that sense that existed before. But I mean, a part of like why I did it at that point was just like the book had to be, the deadline to turn it in was the end of the year. And so and it just happened to be conveniently so that Sam got extradited from the Bahamas back to the US like right around then, which was like, I was like, that's a pretty good end. I mean, like, I don't know, the guy got arrested, then he gets back to the US and is waiting trial. I was like, that seems like a pretty decent ending. So I thought it worked out, but, and I also, like, we have learned some more from subsequent things, but I don't feel too bad that they aren't in the book. Because to me, the most important thing is $8 billion of other people's money is missing, right? Like, like that's the big thing. And like, we're finding out more and more about what happened to that and like, whatever. That's still the crux of the story, is that $8 billion of other people's money is missing. It is interesting to know, for example, that he and FTX and Alameda and FTX may well have bribed foreign officials in China. That's pretty interesting. That probably won't be great for him at trial. But does it like really change how we understand Sam and the injustice that was done to their clients? I don't know. That's just like a different way that they spent money, right? So, like, it's interesting to know that like they owe a bunch of money to Jimmy Buffett's, restaurant in the Bahamas. But it's like, I don't know. It doesn't to me change the story a ton. So, I do think that there will be an interesting accounting done once the trial is done, and then we can like sort of finally see the whole thing. So I think a bunch more things will come out then. And then, whatever ends up happening to Sam later. I mean, I do think the guy is genuinely a genius, so like, who knows? But yeah, I don't know if it makes the best book in the world, but I am glad there is a snapshot of that moment, because I think it's an important moment, and I don't think there's any way to write about that moment except for in it. If someone just waits for it all to be done, that's just going to be a fundamentally different book, and there'll be a couple more done on this. Well, there's already 2 more coming out.
And you meet Michael Lewis.
I did meet Michael Lewis. Yeah.
I will tell you, I know what's going to happen, how they're going to get the money back to the customers.
How's that?
they're going to sue a bunch of people and negotiate and get it back. 'Cause
Yeah.
It's happened before.
Well, how do you think they'll get it all back?
MF Global, yeah. They'll get it back.
What percentage?
It won't
do you
be
think?
the money that he took. It'll be somebody else's money.
Sure.
But anyway,
What percentage
we
do
can
you
talk
think?
about that.
What percentage would you give it?
Depends on how hard those customers fight.
Yeah. Okay. Interesting.
So if
Alright.
if they get together and they fight hard,
Yeah.
they'll get all the money back.
Yeah.
But
Well,
anyway,
this is the tricky thing. Well, sorry. On that though, this is the tricky. It's like the money
There's a
is.
precedent with the same people,
Right, right.
Gensler, et cetera, et cetera.
The
There's
thing
a
that's tricky
precedent.
is like it's so much of it is cryptocurrency, right? So what do you say the dollar value was? Like, what's the date you say is the money in which injustice happened, right? Like, because the value of that pool of $8 billion was pretty different at different periods. You know, it's like I don't know. So.
Yeah, they'll probably have the Madoff rule for that.
Okay.
What you put in is what you get back.
Okay. Yeah. Fair.
At that point in time.
Fair. Yeah.
So, anyway, you talk a lot in the book about how everybody was surprised, and for you it was pretty overwhelming that when all this happened, and even after the charges were filed, he was all over the place. He wasn't following a traditional PR strategy.
Right.
We didn't even know if he had like a lawyer. There were multiple lawyers that were initially involved. It was not clear, like his parents were going to represent him, whatever.
Yeah.
His parents are Stanford law professors, etc. So he's pretty well connected from in the legal community, and it wasn't really clear. But he was like all over the place talking. So talk a little bit about sort of, this strategy of flooding the zone with info and all this talking, and whether you think like that helped or hurt him, and how he probably feels now when he can't really talk as much.
So I don't
like why he did that and what was really
I don't know if I only had an hour with Sam. I talked to Sam as this was all happening. I talked to him like on New Year's Eve of last year. Like I was supposed to turn the book in that day, and then I was just like told my publishers like Sam will talk to me, so like give me a few more days, and they were like that's cool. But I only have to talk to him for an hour, and I don't think we talked about that. But I do think that question really speaks to what I was saying before. I think the fact that Sam was flooding the zone reflected the fact that he did that before he was prosecuted, right? Like, and I think he kind of believed maybe he wasn't going to be prosecuted, and there was a chance, or it was going to be really far off. So I think he did it because he wasn't really worrying about cops. He was worried about public opinion and his investors, and like, could he rehab himself? I think that's what he was going for. I'm not saying it was a smart strategy. I don't know if it worked, but I think that sort of speaks to what I was saying to you before. Is like we all think now, obviously the guy was going to jail, but it actually wasn't obvious then, because sometimes people do very bad things and walk, as we all know. And I think he thought maybe he could convince the world that he just screwed up and he would never be arrested, right?
Do you think he thought he had bought the political influence also?
Maybe, yeah, I don't know. Yeah, I mean he'd never admit to that, but I think that's why he did it, and I think that's what he thought. But I also think crucially, and this I can't prove this, but when it was happening, like there was a lot of people in the crypto world, right, who saw him flooding the zone, and they were all just like, he's going to convince everybody, and he's going to walk, and he's going to be, because they have this sort of paranoia about everything. No one's ever going to arrest him. He's got Gary Gensler in his pocket. It's that's what everybody thought, and they were like, and the reason he's doing this is because he has like the greatest PR team in the entire world, and he's come up with this like dark wizard PR strategy, and I think that's completely wrong. I think that was all just Sam. I think that's just how he is and how he works, and that's how Sam does things, right? So I don't know if it was smart or not, but it does sort of reflect his character.
So much of the book is focused on tracing the history of a lot of different blockchains, coins, tokens, stable coins, protocols, etc., which I was kind of surprised, but I when I got through it, I sort of got it. In other words, you were trying to set the stage, I think, for what the environment was like there and where he was kind of throwing his weight around. But can you explain to me why we need so many different projects to realize the potential of digital assets?
I could give an argument for that, but before I do that, I want to explain why talking about that was important for the book. And I think this reflects one of the first conversations you and I had over Twitter DMs about this time. Was we were talking about they were like this balance sheet came out, that I think the FT got it, that they had been circulating as they were trying to raise more money for themselves, right? And you were just like, this isn't even a balance sheet.
It's a spreadsheet.
And I was like, I don't know what a balance sheet is anyway, so I don't know what you're saying, but
Right.
that's cool. But like the
Nobody listens to me though because I'm a boring accountant.
I mean, I listen. I don't really get it. But like
You do, but
I don't think. But the crucial thing that was on that balance sheet, right? It was saying Alameda and FTX are worth X amount of money, and the reason it was saying that they were worth that money was because they had a bunch of these tokens on their balance sheet, which were worth some theoretical amount of money. Most of it was FTT token. Their own token. FTT was a token they made for FTX, and this is kind of one of the big scoops of the book. Like this is not previous. I mean, you guys probably won't really care, but I was excited to get this. Alameda, is Alameda and FTX were the two main companies in this giant conglomerate of all these different companies. And when it turned out that Alameda had this giant pile of FTT, people were like, why do they have so much FTT? And the answer is when they spun this FTT token out of thin air, which is a nice thing you can do in the crypto world, is you can sort of invent a token for yourself, so it gets a few people to buy it, and you're like, oh, we got more money. Like that's a. I mean, there's some legitimacy to it. It's a little weird too. I get that. So they have all this FTT token. Well, it turns out that the way it was set up was FTT, the pile of FTT never belonged to FTX. The idea from the start was because a bunch of Alameda staffers were going to start FTX for a long time, they were going to spin up this FTT token, they would pay Alameda back by giving them all the allocation of FTT, right? So FTX never really had FTT. This is all kind of arcane, I'm sorry. But
that was actually an interesting point. I think part of what you said in the book was that he rationalized it as these people were helping with all the infrastructure and the back office, and they were doing all these services, and so they were getting paid or holding on to all this Alameda, value token or whatever that he just created out of thin air.
Alameda paid FTX. FTX paid Alameda in this FTT token. But so one of the things I wanted people to understand was all of these different projects and protocols got created, and they all had these associated tokens with them, right? And one of the things that happens, the way a lot of these smaller tokens work is that they have some theoretical notional value in the world. Like, and the way it usually works is just the way when you see the market caps of these tokens played out, it's for a lot of the smaller ones, it's just whatever the last price somebody paid for it anywhere that's the price, for like these low liquidity tokens. That's not true for like Bitcoin and Ethereum, the real big ones, which you have a lot of data, but for these little ones, just like, I don't know, some guy paid $1 for it 2 weeks ago, they're worth $1,
and
right?
Then everything that's out there gets valued
right.
at $1.
So if there's 100 million of that token, then it's a $100 million market cap, right? Which is like, that's nonsense, but like there's not really a better way to do it, and everybody kind of gets that, and like whatever. So on this balance sheet, Sam, in the crucial period in which I talk about all of those different projects in the 2020 to 21 period, which is the DeFi summer era, he spun up a bunch of new projects, either was associated with or invested in or just started on their own, and every single one of them had a token associated with it that they had created, a governance token, and some chunk of those were all on Alameda's balance sheet. And so they were saying, like, we have these billions of dollars in assets because we have all this magic space money that we invented ourselves. It's associated to a bunch of things we've invented ourselves, and those are assets on our balance sheets. And Sam said this many times. He's just like, okay, I accept that the prices that we were saying for those things were overinflated, but they also weren't worth nothing, which is kind of true. But it's really hard to know like what the real difference is.
And he was also using that as currency for some of the venture acquisitions, and also the situation with CZ, paying back that investment that CZ made. He gave CZ FTT tokens, which are these tokens that he created out of thin air.
So it's important. It's important to know. It's important to understand the various things that were like the many protocols that were made in like sort of the explosion of 2020 to sort of get where there's any sense that these magic made up tokens have any value, because the value of those tokens were crucial to propping up FTX and Alameda. But then why do we need lots and lots of tokens? This is the big open question of crypto.
Or stable coins or whatever.
Right.
Yeah.
And who really knows exactly? This is a point that I make in the book, and it hasn't super been proven out yet, but the core idea of one of not an important, I shouldn't say the core idea, an important idea in the cryptocurrency world is that some applications might work better if they can have a native tradable asset that belongs to them. So for example, a really good example of this is there's this protocol called Filecoin, which is a decentralized way to store data around the world. It's a decentralized, trustless approach to something like what's the big one? .cloud, or I don't know. There's a huge one. Dropbox. There you go. It's like a decentralized approach to Dropbox. You can have a lot more control over how your data is stored. It's also, you can have it sort of kind of all over the world by lots of different providers, which means that like if you were an activist organization that had this secret files that some nation state wanted to destroy, like you could make it much harder for them to ever be able to destroy because all these different places, right? And Filecoin functions because it has this native token called Phil that like you have to use to access the network. And this argument is there'll be certain applications that will work better if they have native tokens that are both a speculative asset but also crucial to how the network operates. Utility, right? And so who knows if this thesis is right? But it hasn't gotten a chance to fully play out yet, and that is sort of the notional idea. And so, if that thesis is right, then you're going to need lots of different tokens for lots of different kind of applications that people make. Maybe it's wrong, but that is sort of that's the idea people are operating under.
Mm-hmm. Well, when you were talking about the point in time where CoinDesk, Ian, had this. Found out that basically the balance sheet of Alameda was being propped up by this token FTT, which had been created out of thin air by FTX. Yeah. So there was like this circular motion machine going on between the two firms, and it was propping up the value that they were presenting to other people. Yeah. And then Ian had access to the actual audited financial statements for FTX trading, which is the Bahamas exchange, and then FTX US, which was another entity that they created out of some acquisitions in the US. Yeah. And that was when I got involved with CoinDesk, and they asked me to look at these actual audited financial statements, which was kind of the first time that we had any kind of actual information. It wasn't a spreadsheet, right? Yeah. So everybody had been talking about all this stuff that they had access to, but it wasn't anything that was third-party verified or that we really could look at in a traditional format or know where it came from. It was, instead stuff that looked like it, had been created, on Sam Bankman-Fried's ThinkPad or something that. Yeah. That he drew, with a pen. And so I saw the same thing. So basically there was a lot of circular motion between the various entities, and they were just lending money back and forth, and there were a lot of related party transactions, and there was a lot of lending services back and forth.
And that one line, $4.5 billion, we just kind of can't explain like that.
Right. So lots and lots. So really poorly constructed and very incomplete. And so now those two audit firms are getting sued like crazy. So anyway, so that was an opportunity to actually look at. Somebody else had looked at this stuff and tried to put it into the traditional accounting financial statement and audited financial statement format, and was still pretty much lacking. So the other question that comes up a lot, and we've seen it in other situations, not in crypto necessarily, although it's pretty big there now too, but Theranos and lots of other startups and kind of the startup culture. The venture capital culture, this investor culture, is that investors invested with SBF, and celebrities signed up to endorse the organization, and stadiums agreed to let them put, the name on the stadium. Okay.
Well, he paid for it.
Well, he paid for it, but they didn't do much due diligence. No. Nobody did much due diligence, traditional due diligence about who they were doing business with. Was this legit? The famous story is Taylor Swift, where there was a lot of rumors that Taylor Swift was the only one who actually kicked the tires and, turned away, and now we find out that
She didn't either, yeah.
she didn't either. She actually wanted to sign they wanted to sign the deal, and for whatever her demands were, or whatever, that SBF is the one that walked away from whatever kind of deal with Taylor Swift. But lots of other people signed up, and they were just kind of like blown away. So in your experience, in looking at all the people that were involved in this situation, was it SBF and his charisma, or is it more of a bigger picture syndrome that's going on in the investment world now, regardless of what the product or the service is?
Well, on the celebrities, I mean, I don't know. You'd have to. The punishments they get are never really that bad. I mean, they get a nice big check up front and then a slap on the wrist later. I think the main thing Gary Gensler wants out of prosecuting celebrities is a press release saying that he prosecuted Kim Kardashian, right? Like, that's an exciting day in the newspapers for Gary Gensler. So, I think for celebrities, they're like, look, there's an 80% chance I just completely get away with this, and who cares? And a 20% chance I get busted, and if the decent chance that I get busted, and it's less than what I got paid up front to do this, and so.
But they're not even worried about reputation risk anymore. Like nobody worries about reputation, like being associated with somebody who ends up being a massive fraudster.
Yeah, I think for a lot of the people who he was working with, that wasn't too big of a deal. I don't know. Well, and I guess I do think with Sam in particular, I do think a lot of them, like me, bought him. I mean, it seemed like it's just like, look, he's built. This is the thing that's so crazy about FTX, right? This is an important thing to understand, is that, like, it was a great business. Like, it was. Like, FTX was a great business. It was printing money. Like, and it should have just printed money. Like, it's crazy that this whole thing blew up. Once you've got an exchange going and you've got lots and lots of people using your exchange, like, it is the easiest. It is easier than casino money, because every time anyone's like, if you have a casino, right, an actual casino, sometimes people are gonna like, hit blackjack, right? They're gonna win, right? And so you've got an outsized loss. When you're running a crypto exchange, you've got really no risk once people are in the door. Your only risk is like customer acquisition. But once people are in the door, every time anyone makes a trade, you make a little bit of money every time. And it's not like you ever, like, there's a flip side to that where it's like there's a way in which you negatively make money. Like, even if you are doing derivatives, like, people should be trading derivatives against each other. So it's other customers who are making trades. Piles of people were using FTX, right? It was making money hand over fist. The problem was that Sam didn't think it was enough money, because he thought he had a rare opportunity to make a giant pile of money and fix the entire world. And so he needed to make even bigger bets so that he could have more money than anybody else, right? So, like, this is the crucial thing to get. Like, he had a money printing machine, but that wasn't enough for him because he had this grand vision.
But you say it's a good business, but now, we hear these things from the CEO that was put in place after the bankruptcy. And when I looked at the financial statements, I could see it.
It wasn't well run.
It was not ready for prime time.
No, totally,
okay?
yeah.
Like, they completely disdained any kind of organization, policies, procedures, structures, risk management, systems, anything. They were running the accounting stuff on QuickBooks.
Because you're a bunch of people who already think you're smarter than everybody else, and then you start printing money like crazy, which just confirms to you that you're smarter than everybody else. And so you're like, we don't need to do things all those boring
regular
ways.
stuff all the boring stuff
we don't need to do that stuff.
Like a regular broker dealer or exchange or custodian or
Right. And one of the funny things about that is, a thing I talk a lot about in the book is how philosophy is so important. Like, worldview is so important, understanding this story. And one of the things about the worldview that Sam came from, a big notion in that space, the effective altruism rationalist world, is they actually have a little bit of an ideological safety check on the sort of behaviors they did of, like, skipping things like accounting and proper corporate controls and things like that. They had this notion of a thing called Chesterton's fence. And Chesterton's fence is this idea from this famous English writer, something Chesterton, I forget his first name, sorry about
G.K. Chesterton.
There you go. He had this idea that, like, sometimes you buy a piece of property and you're out exploring the property one day, and you're like looking at sort of changing things, and there's this fence out there in the middle of a field, and you're just like, what's this fence doing? This seems pointless, I don't get it. And so you decide to rip the fence out one day, and it turns out the fence was in fact doing something, it just wasn't evident to you, right? And so the idea of Chesterton's fence is like, don't tear down old practices until you understand what the point of them is, because there might be some reason for that might not be immediately obvious. But like, and I guarantee you, Sam knew about Chesterton's fence. This is like real. This is like year one effective altruist rationalist stuff. Like he was well aware, but they were just blowing through Chesterton's fences left and right, because they were making lots of money and things were working out. So it proved that they were geniuses.
We were talking when we got here. That I just saw Bill Cohen on Puck, was writing about the most recent report that the CEO from the bankruptcy for FTX is issued, and it's more of this kind of the same of like they were completely like, nuts in terms of like not doing anything that you're supposed to do. This was completely disorganized, and I had the question when I saw the audited financial statements, like, what in the world? Why did they spend the money? Why did they even bother doing this? Like nobody does this anymore. Like why did they do this? Who was asking for this stuff? Like this is nuts. And originally we thought when I wrote about it, well, some investor maybe got scared because of the Theranos situation or some of the other situations, because that's all I write about. And these people that don't do proper due diligence and don't focus on accounting and audit and whatever. And that maybe that's why some investor asked, right? But Cohen says today that they were actually thinking about doing an IPO of FTX trading.
Yeah, so they need more money.
And I'm like, what, for whatever reason, or how that did or didn't happen, or who was thinking that was even remotely possible that they could get through that process.
Yeah.
But since it didn't happen, they did it they had these audits, and then therefore they could then go out and raise money, and if somebody asked, they had it, even though they were completely inadequate and ridiculous reports, they were more than nothing.
Yeah.
Had you heard anything about
No,
this
I
IPO?
had not heard of the IPO, but they clearly need more money. I mean, I think that's why Sam said no to Taylor Swift too. It's just we can't afford $100 million anymore. That's not going to work at this point. We're running out of money. So yeah.